Welcome to the Virtual CPA Success Show, where we're 100% focused on helping service-based businesses achieve success. Are you a business owner interested in learning how to scale your business? Has your business reached over $1 million in annual revenue? Then this podcast is for you.
Hello, everybody. Welcome to today's podcast. Today, you have Jamie and Jody here from Summit CPA, and we're going to do a deeper dive on a topic that we've briefly touched on in the past. And we're going to continue to do this as we roll forward on these podcasts. We've had a lot of high level on some topics, but obviously, the more you know about a topic, the better it is to act on it. So today, we're going to work on average bill rate and kind of talk through what that means and ways to improve it, and kind of how to gauge whether you have a strong average bill rate or a weak average bill rate. So, Jody, just want to start off with the real basic calculation. I know we've covered this before, but just kind of give the basics of an average bill rate.
Yeah, no worries. So a lot of times when we talk at conferences, when we ask for everybody's average bill rate, we get a lot of different numbers out there. And the most common number that they give us is not in the dollar amount, but what they call average bill rate. That they're referring to a lot of times is what they're actually billing a client, which is what we call our standard bill rate. And so a standard bill rate is, if I'm going to bill a client $200 per hour, that's the standard bill rate. If I've got many different standard bill rates, let's say my architect is $200 an hour, my dev is $175, my design is $250, whatever that might be, that would be considered a blended standard bill rate. So kind of getting that idea, what we're talking today is not really what you're charging a client, but what you're actually realizing from that sale. So an average bill rate is technically, the definition is taking your total revenue and dividing it by the number of billable hours. So it's very simple calculation. Everybody can do it if you've got a good time and billing software that you can just look at your total billable hours for a period. You can do that for the whole company as to get your average bill rate for the company. You can do that by different projects to get the average bill rate for a project. So it's really a simple calculation, but we have to make sure that when we're talking in this episode that we're actually talking apples and apples, average bill rate versus a standard bill rate or a blended standard bill rate.
And I think the important thing to note here too is standard bill rate does matter for when it comes to your average bill rate. Again, when part of this conversation will be is how to increase that standard bill rate, because it does help your average bill rate. But if you're going out there trying to charge $300 an hour, but then not charging half your hours, then obviously your average bill rate is going to be deeply reduced from there. So it is important that we are focusing on that average bill rate, because it is important that that's ultimately what you're collecting. It doesn't matter what you charge or what you say you're going to charge. What matters is what you actually collect. So that's why we're going to focus on that average bill rate.
Yeah, for sure. And I had a client send me a Slack message the other day, and she was asking, what is our average bill rate, or what should our average bill rate be? That was a major initiative for them. And it really comes down to, one, how much are you charging? What do you feel that you can charge a client? So that's going to be on the sales side of it. And then the other part of it is going to be really what's your effective cost? How much do you actually pay your employees? Because if you're outsourcing your entire team, maybe to a country that has a lower cost, then in that case, your average bill rate doesn't need to be where everybody else is at. It could be a lot lower, because you're going to your profit margin is going to be relatively the same if you reduce it based on that gap between the effective cost and your average bill rate. So it's important to know, it's important to understand your company before you just come out and ask, hey, what should my average bill rate be? Because there's a lot that goes into it outside of just looking and say, hey, what is everyone else charging? That's not the way that I would do it, at least. You might find you have a competitive edge if you charge less and make more, or if you charge more because you've got a higher quality staff, or more expensive staff, I guess is probably a better term. You may have to charge more. You may not have that option of charging less, and so it's important to understand what that average bill rate is, and more importantly, to understand really what your effective cost is, so that you can, basically determine that average bill rate.
Yeah, and it's something I've worked with clients on as well, is having a sliding scale here. Especially a lot of factors can play into making one average bill rate better than the other. If you're going to have a 1 month contract and that 1 month is all that's guaranteed, then maybe you want to go with a higher average bill rate. Or if that client is just a 1 month client, but it's in your industry, it's someone you could impress and turn that into a long lasting 3-year contract, maybe you're willing to go a little lower. Or on the other side, if you're in the initial contract negotiations and someone's looking for a 1-year deal, you might be willing to accept a little less because you get that guaranteed revenue for the next 12 months. And it's something that is going to, you're going to be able to forecast, you're going to be able to predict, and having that lower rate there. So a lot of times I've worked with clients on first establishing that ideal average bill rate and then kind of go in scales, like what could tip the scale one way or the other, and just having little calculations in there while they're doing the negotiating to be like, A, this client's going to pay us fast. They promised 10-day terms. 2, it's going to last a year. Let's go to the level C where we're not going to charge our normal 200. We're going to charge them 180 because we have all these positive factors in there. So that's a thing that I've worked on with clients. It's something you could easily do on your own if you understand that base average bill rate.
Yeah, and I'd also say if you're in a situation where maybe you've got a cliff, where maybe a project's falling off and you've got maybe 15 days before the next project starts, it's not a bad idea taking a very small average bill rate just to fill that time. It's a lot better than no bill rate at all. And so, that might be one of those, pet projects. Like, let's say maybe the church down the street needs some help on a project. Obviously your bill rate's way higher than they can afford, but you've got this little area. If they're willing to work within that gap, you could use that 15 days and do their project at a much lower. Again, much better getting nothing or getting something than nothing, right? I mean, that's the idea there. So don't fool yourself and think that, hey, we can't lower a price because it's going to lower our average bill rate. Again, zero is a lot worse than getting maybe $100 when your average bill rate is normally $200.
And I think going back to Jody's point earlier, like understanding what that break-even average bill rate is super important. And again, knowing what your costs are and knowing, really understanding your income statement, you can kind of back into, okay, 180 gets us to that 50% gross profit, which is great. But if we need to fill some time, or we're in a really bad time where the last 3 months we just had no projects come through, with obviously right now a couple clients are working with that because of the current economy. So like you could say, I'd rather have my team here and working on something than not doing anything. So understanding that, that break-even cost or rate is super important as well. Just as it also gives you that scale. Kind of when I was talking about the 200, if the lowest you can go and break even is 110, then that you never want to go lower than that, obviously. So
yeah, for sure. And to Jamie's point there, it's important to know that. But in the same regard, I'll take a loss for 15 days. If I get money in the door, I'd have no problem with that, just as long as it's not a long-term deal. If it's a long-term deal, absolutely not. You got to actually make sure you know what that break even is. You've got to know what your bill rate is, and you've got to be able to command your bill rate. You can't take a loss or a really small margin on a long-term contract, as more than likely that's going to lead to a disaster in the end.
Yeah, and I think one last thing I have on the kind of the what you charge clients part of this calculation is I have a couple clients that have multiple different industries or multiple different sectors, and they make sure that they get a lot on kind of the big companies. If they're working with a Facebook or a Google or Ford or some of these large companies, those companies are going to be willing to pay more, so you can charge them a little more. And there's nothing wrong with that. There's nothing unethical about that. That's just the type of work you're doing there. That work is more valuable, and it's more valuable to them, and they're going to pay you a little more for that. But then you can blend that with some startups. So if your industry is doing large companies but also startups, you're not going to charge your startup the same that you would those large companies. So just to understand those two things and really have that part of your scale as well, just to know, because a startup is never going to pay the same rate as a Facebook. It's not going to happen just because of where they're at.
For sure.
So anything else on kind of finding that standard bill rate, Jody, and pricing it for clients that we need to talk about before we kind of get into write downs and once the job is started?
No, I think it's just important that the communication between the sales and the project manager, the account manager, it's got to be completely a transparent transaction. Because what happens is, and we're going to talk about write-ups here, hopefully write-ups in a second, which we obviously know that's not generally the case, but it's important that it's really on the very front of the engagement. So we recommend always having, the project manager, whoever's leading that project in on the sales discussion. So, or signing off on it before it's actually brought down to them, because that's going to really potentially lead to some major write-offs or write-downs if there's something missing, the scope's changing a little bit, miscommunication, that sort of thing. So we definitely want to make sure that on the front end, looking for your price, make sure that the sales and project manager is involved in that discussion.
Yeah, that's a great lead in, because that's what we're going to talk about next, is that write down, write up. And I think you're 100% right. I think the first step to that is having the PMs and having people who understand the project involved with the sales process. That's the number one tip that I always give people is, I can't tell you how many times I've been in a revenue rec meeting and we're talking about percent complete, and I hear the PM complaining about the salesperson. Like, I don't know why they sold it at this rate. There's no way I'm ever going to do it. And it's like, well, my first comment is well, why aren't you involved in that process? Why aren't you, how can we build our controls better so we don't get those type of jobs? And again, sometimes they're okay. We talked about that. If it's that, client you've been trying to work with for 6 months now, sometimes you're willing to take a little bit of a write down on it. But ultimately, to me, that's the first step is just understanding what goes into that pricing model. So that's key. And so, Jody, do you want to talk a little bit more about what leads to those write-ups and write-downs and what exactly we're talking about there, just to make sure our audience understands that part of the calculation?
Yeah, for sure. So when we say write-off, we're not talking about a bad debt situation. We're not talking about after the project's over, the company fails to pay you. We're not talking about that. What we are talking about is what was expected to be billed out and what actually does get billed out. The difference between your standard rate and your average bill rate. So when you do your calculation, if everybody does that and looks at your total revenue divided by total billable hours, and then it comes out to 200. Let's say it comes out exactly to $200 an hour, and that's what you're billing your clients. High five, you're getting exactly what you're billing. I would guess that if everybody does that, that's not going to be the case, and you're going to probably find big swings in there. What we like to say is that big swing really should not be more than 5 to 10%. If it's over 10%, there's some major issues that you've got to correct. And don't look at it as being a one-off all the time, because everything becomes one-offs. Just do a deep dive and figure out, hey, where did we go wrong? Where are we going wrong? Where can we fix the issue? Because there's definitely an issue. If we're between 0 to 5%, probably not a huge issue at all. Probably something you can live with. I wouldn't worry about it too much, and I'm not going to lose any sleep over it. And I'm really not going to lose any sleep when it gets up closer to that 10%. But I will start losing it when it gets greater than 10%. And so there's a lot of reasons for why you might not be getting that complete thing. We just talked about the sales to the the miscommunication, the communication gap between sales or biz dev and project management. That's one, and that's a big one. The other one is basically just managing the project. Project may be going over scope, and instead of billing for it or getting approval before we add extra stuff, we go ahead and do it, and then find out afterwards we can't actually bill for it, or we decided not to bill for it. And we're all guilty of that. We always want to provide a service that's cooler, better than and basically show that we can actually do it. And so we want to provide that, but unfortunately we have got to make sure that if we're providing something better than what we're scoping, we've got to make sure that we actually get paid for or get approval before we do it, because a lot of times it leads down to a rabbit hole that it is going to cost us in the end. And that's where we start. That's where we have a big write up, or unfortunately a big write down in that case.
So I think to that point, the big thing, the key there is communication with the client. If as you're going through it, like, the whole team needs to be in sync. From the lowest level to the highest level, we need to understand what the original scope was. So if the low level designer starts working on something that's out of that scope, we need to make sure the client's aware of it and saying, hey, just so you know, I'm going to start working on XYZ. This is out of the scope. So every hour I spend on this, we're going to have to negotiate afterwards, or this is the rate it's going to cost you. Be a little more straightforward with it, or say, well, I'll have to talk about before we start that work. It's a lot easier to have that conversation then than it is when the project's been going for 90 days and it's over and you're trying to send that final invoice. You're like, oh, by the way, in month one, we spent 100 hours working on this part of the thing that you requested that was out of the scope. Pay us for it. Most clients are going to laugh at you and be like, no, we had no clue that was going on. And so the big thing about scope changes and scope creep is the communication throughout the process. And the big thing there is making sure everybody understands what the scope was and understanding who's the one to have those conversations and to have them quickly and timely. That's the biggest thing that I think that I've seen be effective with trying to reduce those type of write-downs.
Yeah, for sure. And the transparency, I think, also that we give our project managers is going to really help out in determining, that average bill rate, making sure we maintain that average bill rate. Because oftentimes our project management team really have no idea what our effective cost is. So there's really no way that they can actually, if you don't know that, it's really hard to determine, really what if you're on the right path or not. They're just looking at hours, but as we all know, everybody's hours differ. My hours is going to cost more than somebody right out of college's hours, that type of thing. So it's important to understand what the overall, it's basically the transparency of it's really important. Now, there is a way of getting around that without actually opening up the playbook when it comes to how much we're paying everybody on the team, because you may not want the project manager to know that. And you can use that average bill rate. And Jamie, if you could explain, how you would walk a client through utilizing that average bill rate to determine job profitability, I think that'd be pretty valuable for the audience.
Yeah, for sure. So it goes back to what Jody mentioned before, is you understand your costs, you understand how much you're paying your employees, and you understand what it takes for a job to be profitable within your organization, then that average bill rate is all you really need to know. So if I know I'm paying my employees on average $50 an hour, obviously you need to take into consideration there's some utilization, but let's just say that $50 an hour equates to $125 an hour average bill rate. That's the starting point. And then again, if you use that as your starting point and you say, I know I need $125 an hour, but I priced this one at $150. You understand you priced that one at $150, and you're going to get a little bit higher than that 50% gross profit. And so that's all that your PM needs to know is how am I doing on average bill rate throughout the project. And for them to do that, it's super simple. They just need to know how much revenue they've earned and how many hours they've worked. So at any point in time, they should be able to calculate, okay, if it's T&M, I've worked this many hours on it, I can take it out of Harvest and calculate how much revenue I've earned. And then right there in Harvest is also how much billable hours you have. You can see what your average bill rate is at any point in time. And then I think the second part of that, which I always recommend too, is don't just do the average bill rate now. Okay, so as of day 10 of the project, our average bill rate is fine, but also do it at the end of the project. So all of your PMs should be able to lay out a planning document, whether it's in Harvest Forecast, 10,000 feet, or just on a spreadsheet. They should know that this is what it's going to take for me to complete this project. By the end of this project, this is where I'm going to be at. And that comes into really important when you're talking about those fixed price projects, because at any point in time, you're going to feel like you're doing okay unless you throw in those, 2 completion hours. And then you really know, okay, wow, at the end of this project, if we keep going on the pace we're going right now, we're only going to get $99 an hour on this project. That's not good. We need to either talk to the client today, we need to change something, we need to change the team on here and be more efficient, or do something to get that rate back up, because if not, we're going to have a pretty significant write down.
Oh, for sure. And so can you kind of walk through what how we do our revenue rec when it comes to a flat fee project? Because it's fairly simple with a time and material, right? Hours billed, hours billed equals hours worked, that type of thing. But how do we do a fixed fee project? And let's say that we had you could throw a number out there, but you're tracking hours as you go, and then how's the revenue determined, I guess?
Yeah, so there's a couple ways to do it, and again, we've talked about this in presentations before. So if you ever have a chance to see us talk, we'll go into this in a little more detail. But it really just depends. You want to try to tie that revenue to when it's earned as best possible. So one of the easiest ways to do that is if you have milestones, and so every time a milestone is achieved, you know that you've earned some part of revenue. And again, milestones aren't always equal, but let's just assume it's a $150,000 project and there's 3 milestones. You can take $50,000 once that milestone is achieved. And again, if you're halfway through a milestone, you can kind of estimate it there. But milestones is one way to do that. It's pretty simple, pretty basic, but it gets you close. And so that's one way to do it. But again, you have to have
again, milestones aren't tied to hours, right? They're just simply when the project's completed divided by
when certain levels are completed. Yeah. So if you know stage 1, when you kind of do the basically the discovery, once you get done with discovery, you're 10% done with the project, then you can recognize 10% of the revenue. And then stage 2 is once you get the phase 1 done and you've presented it to the client, that's phase 2. Phase 3 is going back and doing the cleanups, and that's another 50%, or however you want to break it down. If you understand the phases of the project and know that they mean we're X% done, then you can use that to recognize the revenue as opposed to the hours. Okay. So that's one way to do it. And I think, that's probably the simplest way, because that's the way a lot of people think. The other way to do it, and this is kind of what I was alluding to earlier, is if you as a PM understand what % complete you are, then you know how far your revenue is. So if I have a schedule and I know a project's $200,000 is a total project, and I can see how many hours I've done, and I also have somewhere document how many hours it's going to take for me to complete, I know how far along I am on this project. So if originally I thought it was going to be a 2,000 hour project, and I've put in 1,500 hours, and I'm only 50% complete, obviously I'm behind because 1,000 hours would be that 50% complete that I think I'm at. And so then you'd have to put that $1,000 on there and say, okay, I can really only recognize 50% of this project or 2/3 of this project, which means I'm behind. And so it's basically just understanding the project as a whole and knowing what percent you are complete and just using that to do the revenue. So actually, it's not that complicated if you're just looking at that at a project in total. Is how much time do I have left? How much time have I put in? And what percentage am I at? So then you can just know, okay, I'm 60% of the way done. 60% of a $200,000 project is $120,000. That's how much revenue I'm going to recognize, and then divide that by your billable hours, and you can see exactly where your average bill rate is at.
Yeah.
So it's a little hard to talk about this without slides.
Yeah, for sure, for sure. But
the best
I think that's pretty clear. The one thing you can have a twist to that. What a lot of our team will do is they'll on the percentage of complete, they're going to actually go with actual hours up until 70% of the project's complete, and then start actually breaking it out as a percentage. Because often, a lot of times, we underestimate or overestimate in that first part, and it's really tough because you're in the first part of a $1 million engagement or first part in a $300,000 engagement. It's really tough to determine, hey, am I 25%? Am I 30%? So a lot of times we'll just go strictly by hours, and then once they get to that 70% or 65%, then we actually break it down as a percentage of complete. So you can do both. If we're really good at estimating that first part, or we got some sort of milestone or some sort of indication that 25% is done, then we'll go that route. And if we don't, we'll just use strict hours, like Jamie was saying, and we'll just go strict hours all the way through, and then start breaking it down and start having write-offs typically towards that last quarter. And that's probably the most conservative method of doing it, in my opinion, as waiting at that point.
I think the key there too is just knowing. The sooner you know that you're going to have a write-off, the easier it is to go to the client and talk about it. So again, you don't necessarily need to know in terms of dollar amounts how much the write-off is going to be. But if in that first third of the project, it's going out of control and they're asking for a ton of scope changes, and you just know that this project's going backwards, you need to talk to them then instead of wait until that fourth quarter.
For sure.
I agree.
For sure.
You don't necessarily need to know how much revenue you have or your average bill rate, but you need to know if you're falling behind or ahead.
100% agree. 100% agree. And so I'm referring more to the revenue rec than I am actually the job profitability in that regard. Right. And if you're ever under like an audit, and I'm talking about like a financial statement audit where you've got to do your audit once a year, being more conservative and doing it at 70% is going to be more favorable to the auditor than if you're recognizing a lot of your revenue up front, which could be a bad thing. So make sure that you know the situation and understand what who your audience is. If you're not an auditor, you'll never go under an audit, and you're just worrying about the IRS, well, the IRS is going to want the revenue being recognized a little differently. So make sure that you're really consistent and you're recognizing revenue to your audience for the most part, and try to stay in what we call GAAP accounting if you can. But I know a lot of people won't have the accounting acumen to actually stay exactly within that. So like I said, try to stay as close as you can to when the revenue is earned, and you should be okay.
For sure. Yep. Okay, so I'm going to take a quick second here to throw our email address out. So the emails have started to pick up, which is nice. I know we have listeners out there with questions for us, but wanted to throw it out there so people know. Again, we want to make this show for the listeners. So if there's any topic you want us to talk about, any questions you have specifically, or even if you want to be a guest, we'd love to have you on here and kind of talk through your issues individually. So that email address is vcfo@summitcpa.net. Again, vcfo@summitcpa.net. So kind of last topic here, Jody, for you is, so you mentioned, we talked a lot about write-offs. So what about write-ups? So if I have a 20% write-up, is that a great thing? Do I need to change anything about my business? Is there any level where I should start worrying about write-ups? On the flip side of that.
Yeah, definitely, for sure. I think write-ups are probably equally as bad as write-downs, and that's going to come as kind of a weird statement to say, because you're actually making more than what you would have, what you would have charged. What that's telling me is you're probably not charging enough, and there's probably a lot you're leaving out there, that you could have actually charged even more on. So maybe instead of if it's a one-time deal, that's cool, no big deal, no change there. But if it's a constant thing where you're constantly writing up, then you probably want to start quoting a little bit more, getting bigger deals. I think that's a big sign for that.
Yep, I agree. And the other part it gets tricky with is your capacity planning. So if you think a project's going to take 3,000 hours over the next 3 months and it only takes 2,000, then obviously you're having people sit on the bench more than you should, and so you can be making additional revenue. And so that's the other part of it too. Is both write-ups and write-downs mess with your capacity planning, but write-down specifically means you are still leaving revenue on the table in terms of people's hours not being used.
And kind of to Jamie's point, it'd be kind of interesting if you did it and you find out, oh, we're having write-ups on everything, but I'm not hitting my gross profit margin. Again,
Yeah.
exactly what Jamie's saying. That can definitely happen. We've got a lot of bench time, and the bench time is eating in your gross profit. So it could be equally as bad as it could as a write-down, if not managed properly, for sure.
Great. No, I think that's a great point, and I think that's both of those things are equal, because I think I've had a lot of clients come in and be like, "Oh, look at all these write-ups I'm getting," and they're celebrating. And I get it; it's nice to beat your estimates on a project, but when it comes to planning the whole company and your pricing model, like both of those things are obviously off if you're having a lot of write-ups or write-downs.
Yeah, and there's another thing too. When looking at the different type of work you're doing, if I'm actually doing a lot of service work where I'm actually where it's retainer based service work. I'm not going to want a whole lot of write-ups during that time. I'm going to want to make sure that I spend maybe even more time in that service work to make sure I at least bill what I'm there, because do the extra legwork for there, and you're going to have a client forever. If your goal is on your service work to get it done as quick as you can and get the highest margins you can, you're going to probably lose clients. And so I think it's really important to maybe even overserve a little bit on your recurring revenue work, and I think you're going to come out in the long run for sure. And I'm not saying take a loss or anything like that. I'm just saying make sure that write-up, write-down is within 5 to 10%, as opposed to having a 50% write-up because you didn't have a whole lot to do this month, so you didn't do anything. That to me, that it goes a longer way if you're actually spending money, maybe doing a couple extra things for that client that maybe you wouldn't have done, or do a little perks. I think that's going to go a long way in client retention and client relationships.
Yeah, and I think I know we had a podcast on recurring revenue, but this is exactly what Jody's talking about. Is like, the reason recurring revenue is so awesome is because it keeps happening. It keeps recurring. So if you could make that recurring revenue, if you can make your recurring revenues average 24 months versus 12 months, then that's what you want. And so if you sign up for that recurring revenue and then you're underserving them for 12 months, they're gonna be like, wow, what are we paying for with this agency? Like,
Exactly.
I only talk to them once a week, it's not there. So you want to make sure that you're still paying attention to them. And in those months, they're not asking for much. Reach out to them, say, hey, is there anything we can help with? Or maybe it's the time to do that patch that you've been thinking about, or just that, really track those hours on a monthly basis and know that, okay, last 2 months, we've really had some write-ups on this. Maybe this third month, we should do something. We should do something to keep that client happy, because it's the value of recurring revenue is the time frame,
sure.
not the dollar amount.
For sure. 100% agree.
Cool, Joey. So any final thoughts? I think we've talked about a lot here, and hopefully people are taking notes quickly and getting this all out there. But any final thoughts for the listeners?
I would just say, just make sure that you know what it is, manage it on a weekly or monthly, at least on a monthly basis, know what your average bill rate is, know what your average bill rate is per project. It's a very important tool that you have in your tool bag to actually help your bottom line profit margin. So knowing how much it needs to be, managing on a regular basis, and then making corrective actions when you don't hit it. I think those are for sure the key.
Yep, definitely. I think the more people that know, the better. I think you can't your PMs shouldn't be the only ones that are knowing. Your sales team should know, your CEO should know, your CFO should know, anybody within the organization should know what that average bill rate is, because they all take part in it. So I think that's the other part, is just don't keep it secret. Don't keep it close to the vest, because it is really important for everybody to know each project, how they're performing and what's causing it. So.
For sure.
Great. Well, I appreciate you joining me, Jody. I think that was a really good topic.
Yeah, thanks, Jamie.
Enjoy this episode? Visit our website at summitcpa.net to get more tips and strategies for achieving virtual CPA success. We're here to be a resource in this ever-changing industry.